Wolfspeed, ticker symbol Wolf, has been on a wild ride lately, capturing the attention of both seasoned investors and newcomers alike. The company, known for its cutting-edge semiconductor technology, has seen its stock price swing dramatically in recent months, making headlines and sparking heated debates across the financial world. With its stock price tumbling and investors feeling uneasy, the mood around Wolfspeed has shifted from optimism to caution. Many are now questioning what's really driving these sharp declines. When a stock drops sharply, it's natural to wonder what's going on behind the scenes. Is this just a bump in the road, or the start of a much bigger problem for the company and its shareholders? Is this a temporary setback, or a sign of deeper trouble? Investors are left searching for answers, trying to separate fact from fear. For Wolfspeed, the story is complicated. The company is at a crossroads, balancing ambitious growth plans with the realities of a challenging market. The company is pouring money into new factories, huge capital expenditures that mean losses today, not profits. These investments are designed to secure Wolfspeed's future, but they come at a steep short-term cost. Wall Street doesn't like waiting for returns, especially with high interest rates making borrowing more expensive. The pressure is on for Wolfspeed to prove that these investments will pay off. Some see the falling price as a red flag, a warning that the company's strategy might be too risky or that management has lost its way, warning of risky plans and lost confidence. But there's another view, one that sees opportunity where others see danger. A falling stock can be a rare opportunity to buy a future leader at a discount. For those willing to look past the headlines, Wolfspeed's current troubles might be a chance to invest in long-term growth. The real question is whether Wolfspeed's long-term potential remains strong, or if the company's challenges are too great to overcome, or if it's a broken company, unable to recover from its current setbacks and destined to disappoint investors. As investors, our job is to look past the fear and dig into the real reasons behind the drop. We need to analyze the company's fundamentals, management decisions, and industry trends. Is this just a painful investment phase or something more serious? Are we witnessing a temporary storm or the start of a long-term decline? Understanding the why behind the numbers is the first step to making a smart decision. Only by digging deeper can we separate noise from real risk. Let's break down what's really happening at Wolfspeed, examining the facts, the fears, and the future outlook for this ambitious company, and whether this storm is a warning or a buying opportunity that could reward patient investors. The answer could shape your portfolio for years to come. Let's dive in and uncover the real story behind Wolfspeed's stormy season. So what's Wolfspeed's business all about? What makes this company stand out in the world of advanced technology and semiconductors? In a word, silicon carbide. This unique material is at the heart of everything Wolfspeed does, and it's changing the game for high-performance electronics. Traditional chips use silicon, but as our devices and infrastructure demand more power, speed, and efficiency, silicon is starting to hit its physical and technical limits. Enter silicon carbide, stronger, more heat-resistant, and far more efficient at handling high voltages and temperatures. It's a material that opens up new possibilities for the future of electronics. Wolfspeed doesn't just make the raw silicon carbide material, they also manufacture the advanced chips that power everything from electric vehicles to 5G towers, industrial motors, and even aerospace systems. These aren't the brains of your devices, they're the muscle, managing and converting electrical power with less waste, more reliability, and greater performance than ever before. In electric vehicles, Wolfspeed's chips help batteries last longer, charge faster, and let cars go farther on a single charge, making EVs more practical and appealing. In renewable energy, their technology makes solar and wind power systems more efficient, reliable, and cost-effective, helping to accelerate the shift to clean energy. Wolfspeed isn't just a player, they're a pioneer, with decades of expertise, a deep patent portfolio, and a significant head start on competitors in the silicon carbide space. Their big bet? That silicon carbide will become the new standard for high-power, high-efficiency electronics across multiple industries. If they're right, Wolfspeed could become the backbone of the next generation of technology, powering everything from data centers to smart cities. That's the story behind the hype, and why so many eyes are on Wolfspeed right now. Now, let's see who's buying into this vision for the future. Wolfspeed's future is tied to its customers, and they're some of the biggest names in the game. The automotive industry, especially electric vehicles, is Wolfspeed's main market. Silicon carbide is a game changer for EVs, making batteries more efficient and cars lighter. Wolfspeed has landed multi-billion-dollar deals with giants like General Motors and Jaguar Land Rover. Beyond cars, their chips power renewable energy systems, fast-charging stations, and even 5G networks. As the world shifts to clean energy and electrification, demand for Wolfspeed's tech is set to soar. Their products help everything from data centers to wind farms run cooler and more reliably. By partnering with leaders across industries, Wolfspeed isn't betting on just one trend. They're positioning themselves as a key supplier for the biggest technological shifts of our time. That's a powerful place to be. But how do they stack up against other market favorites? Investors love high-margin software companies, but Wolfspeed is a different beast. Software can scale fast and cheaply, but Wolfspeed's business is capital-intensive. Factories, equipment, and years of expertise. That means lower margins and lumpier profits, but also a massive barrier to entry. Building a silicon carbide factory isn't easy. Few can match Wolfspeed's know-how. While software faces endless new rivals, Wolfspeed's moat is deep and hard to cross. Investing in Wolfspeed is about backing the physical infrastructure of tomorrow's tech, not just the apps that run on it. It's a different philosophy, one that rewards patience and vision. Both approaches can pay off, but Wolfspeed's path is for those willing to wait for big, foundational change. The question, do you want fast profits or to own a piece of the future's backbone? Let's look at why some investors are bullish and why others are wary. Here's the bull case for Wolfspeed. They're a leader in a technology that's essential for the global shift to electrification: cars, energy, industry. Wolfspeed is building the world's largest silicon carbide factory, betting big on future demand. These investments hurt profits now, but could cement their dominance for years. They've secured over $20 billion in long-term customer commitments, especially from top automakers. When a car company designs in Wolfspeed's chips, it locks in revenue for years. The current low stock price reflects short-term worries, not long-term potential. For patient investors, this could be a classic buy low moment. If Wolfspeed executes, today's pessimism could turn into tomorrow's big gains. But what could go wrong? Now, the bear case. Wolfspeed's ambitious factory build-outs are risky. Delays or cost overruns could hurt badly. Competition is heating up, with big players and Chinese rivals investing heavily in silicon carbide. Price wars or better tech from competitors could erode Wolfspeed's edge. The company is burning cash, making it vulnerable if markets tighten or if it needs to raise more money. Profitability is still years away, and a recession could slow EV and green energy demand. If the market for Wolfspeed's products stalls, those massive new factories could sit underused. Manufacturing is always a bet on future demand, and sometimes the future arrives slower than expected. These risks are real, and not for the faint of heart. So what can we learn from history? History is full of companies that looked risky before they became legends. Take Nvidia, now an AI powerhouse, but once just a gaming chip maker whose stock crashed more than 50% at times. Or Netflix, which went from mailing DVDs to streaming, facing skepticism and stock crashes along the way. Both companies invested heavily, endured doubt, and took bold risks. The market often missed their long-term vision, focusing on short-term losses. But patient investors who saw the bigger picture were richly rewarded. The less than world-changing companies often look messy and risky in their early stages. Heavy investment and volatility are part of the journey. Wolfspeed fits this pattern: big bets, big risks, and potentially big rewards. The key is to focus on the long-term story, not the short-term noise. If you can do that, you might catch the next Nvidia or Netflix. But it takes patience. Investing in Wolfspeed isn't about chasing quick wins or overnight riches. It's a long-term play that requires vision and discipline. This isn't the kind of stock you buy today and expect to double by next week. Instead, it's about believing in a future that's still being built, brick by brick. The real payoff, if it comes, will take 5 to 10 years as new factories ramp up, production scales, and electrification accelerates across industries. Patience is essential, because these massive projects and industry shifts don't happen overnight. They unfold over years, sometimes even decades. The stock will be volatile and headlines will often be negative. There will be moments when the market panics and the price swings wildly. It's easy to get caught up in the noise, but that's when patience matters most. You'll need to look past quarterly losses and focus on the company's progress. Are factories on track? Is management delivering on their promises? Are they hitting their milestones even if profits aren't immediate? Are new deals being signed? Are partnerships forming that could pay off down the road? These are the signs of long-term value creation. Is the tech still best in class? Are they innovating and staying ahead of competitors? These questions matter more than short-term earnings. Think of it like planting a tree. You won't see fruit for years, but the payoff can be huge if you wait. The roots need time to grow strong before you see results above the surface. Only invest money you won't need for at least 5 years. This is money you can afford to let grow, untouched, while the company matures. If you need cash soon, Wolfspeed's volatility isn't for you. The ups and downs could force you to sell at the worst possible time. Long-term investing gives the story time to play out and protects you from selling at the wrong moment. It lets you benefit from the company's full journey, not just a single chapter. Patience isn't just a virtue here, it's a requirement. It's the difference between giving up too soon and reaping the rewards of your conviction. If you can't stomach the ups and downs, it's okay to sit this one out. Not every investment is right for every person, but if you can, the rewards could be worth the wait. Sometimes the biggest wins go to those who simply hold on. So, should you buy, sell, or hold? The answer depends on your patience, your goals, and your belief in the long-term vision. After weighing the risks and rewards, what's the move on Wolfspeed? If you're near retirement or can't handle big swings, it's wise to wait. There are safer stocks out there. But if you have a long time horizon and can stomach volatility, Wolfspeed could be a compelling buy at today's beaten-down price. They're a leader in a critical technology, making the right investments for future dominance. The market's pessimism gives you a chance to get in early on a potential growth story. Start small, maybe 1 to 2% of your portfolio, and watch the company's progress. Add more only if they keep executing and the story improves. This way, you get exposure to a transformative company while managing your risk. The journey won't be smooth, but the potential payoff could be huge. The choice is yours. Are you ready for the ride?